I'm Jim Poplava, and welcome to a special edition of the Financial Sense Newshour. At issue today will be a debate regarding the gold market. Is the gold market and the price of gold being suppressed by central banks and bullion banks? Or is the fact that we operate under a fractional reserve system and there's leverage keeping the price of gold down? That will be at issue here today. Joining me for this debate will be Bill Murphy. Bill Murphy is chairman of GATA, the Gold Antitrust Action Committee. He's also proprietor of La Metropole Cafe. On the other side of the debate will be Jeff Christian, who is founder and CEO of the CPM Group. Gentlemen, both of you are friends of this program, having been on the program a number of times, and I appreciate both of you agreeing to come on and do this debate. However, debates can be either constructive or destructive. Most of the debates, at least I see, on cable TV channels are destructive in nature because, well, you've seen them so far. They get chaotic, they're filled with invective, and you never get to the bottom of an issue. So, the purpose of a debate is to arrive at the truth of an issue, allowing opposing sides to air their views, to interact, and to challenge the views of the opposing side. My job here is going to be to act as a moderator and not take sides in this debate. At the end, I may ask some of you some challenging questions from both sides, and I may ask for clarification during the debate. For the most part, I'm here to moderate, so you should feel free to interact with each other, but just like boxing, I may have to separate you from time to time. We do have one cardinal rule that we have on our program. You can challenge the ideas, but not the integrity of the person behind them. So what I'd like to do as we open, before we get into the individual debate, I would like to allow each side to state their case as briefly as they can. And Bill, let's begin with your view.
Well, the Gold Antitrust Action Committee was formed in January of 1999 to expose the manipulation of the gold price and silver by a bunch of bullion banks. After long-term capital management blew up, they had to consort to keep the price down, which is eventually why the Bank of England had to let some of their gold at the bottom. As time went by, we realized the Treasury and the Fed were also involved, and we believe through our 11 years' worth of work and effort that we've been proved correct as it all hangs together. And even in terms of the price, as you well know, Jim, GATA has been probably the most bullish people out there. We've been bullish all the way up. We've been right 10 years in a row. And in essence, the gold cartel is running out of gold to carry on their price suppression scheme. And it's becoming pretty clear, even in terms of the European central banks. Frank Venerosa, one of our consultants, said at our conference we had in Durban, South Africa, May in 2001, that in 7 to 10 years, a lot of the banks would run out of gold to carry this out. Basically, that they've been adding a supply, and while the European banks have been above board, the rest of it has been below board, and we believe that the central banks have less than 15,000 tons of gold left, whereas the mainstream gold world says there's 30,000 tons of gold. And so we're not surprised about the price action, where it is, and making all-time highs. We're extremely bullish. We had a full-page ad in the Wall Street Journal, January 31st, 2008, in which we said gold was going to go to $3,000 to $5,000 an ounce to clear the market. And so far, our camp's been vindicated, while most of the mainstream gold world has been neutral to bearish all the way up, and they still are today. I mean, you've got people like SocGen and Barclays talking about $800 gold as their goal for the end of the year. So we're pretty excited. We believe we are correct because we understand the ramifications of the price suppression scheme, and we knew what was happening. We know that they're just managing their retreat, and gold and silver have a long way to go, and if we're correct, there's going to be many surprises on the upside, which we can get into later in this discussion.
And Jeff?
Well, I'll be a little bit more succinct. I have been involved in the gold market since the 1970s. I have an excellent track record of calling the gold market both on the upside and on the downside. There were extended periods of time when we were saying gold prices were likely to fall, and they did, and there were extended periods of time when we said the gold price was likely to rise, and they did. I look at it this way. I think that as you look at GATA's evidence, you'll find that it's not convincing. In fact, I think that what you find is that GATA regularly distorts quotes from other people and the reality of the markets. I think GATA's evidence, if you look at it with a discerning eye, with the eye of a reasonable person, as the U.S. court system would call it, is probably more indicative of the fact that there's nothing there, that they haven't found any evidence. And quite frankly, in all of my years of involvement in the gold market, I've never seen any evidence of any efforts to manipulate or suppress the price of gold, other than, the odd trader coming in at the opening or the closing to gun the stops or hammer the opening or hammer the closing. In fact, I've seen a lot of evidence to the contrary. And in terms of my position in the gold market, I've been a major analyst and advisor to all sorts of companies, including major producers, major investment banks, major institutional investors, central banks, governments, and others. And I've never seen any evidence of any effort. Nowadays, in the last month or so, we've also seen talk about gold being managed as a fractional reserve currency. And I think that is just an effort to distract GATA's audience attention from the reality that we've called them on the consistent inaccuracies of all of their previous statements.
All right. Well, let's get into the debate. And to begin this debate, I am going to go with GATA. GATA put out some things that they wanted to be clarified regarding their position on the market from you, Jeff. And this is taken from the March 24th, 2009 GATA website. And I'm going to read the first question. Jeff, I'd like you to respond to what GATA is asking you. And then after your response, Bill, you will be allowed a rebuttal to that. But let's begin with the first point. Point number 1, and this is made by GATA. The minutes of the Federal Open Market Committee meeting of January 1995, which quote the Federal Reserve's General Counsel Virgil Mattingly as acknowledging that the U.S. government has engaged in gold swaps. The only purpose we can figure for gold swaps is market intervention. The more so insofar as Mattingly, when confronted with his comments years later, indignantly denied making it. So, Jeff, how would you respond to that question?
Right. The last sentence in that paragraph in GATA's website was, maybe Christian can offer some other explanation. And I can. And I think there are 2 points. First off, I'll explain what Mattingly was talking about and the situation in which Mattingly was talking about that. But the other thing is they have this saying, which is a GATA opinion, the only purpose we can figure for gold swaps is market intervention. And I think that when you understand the context of what was going on in January 1995, you understand that there are other reasons for swaps. Now, in that January 31st, 1995 meeting, the Fed economists were briefing the Federal Open Market Committee on the Treasury's plan to use the Exchange Stabilization Fund to lend money, not gold, but money, to the Mexican government because the Mexican government was facing a peso crisis. Fed Governor Lindsay asked the staff if the way the Treasury planned to use the Exchange Stabilization Fund was within the legal and regulatory authority as to how the ESF could be used. Fed economist Truman commented that it was, and that the ESF had been used for loans to at least 31 countries over the last 50 years. Lindsay asked if the sort of loan envisioned for Mexico would fit the ESF guidelines, and Mattingly said, and I quote, "It's pretty clear that the ESF operations are authorized. The statute is very broadly worded, and it has covered things like the gold swaps, and it confers broad authority." Now, the ESF does have broad authority. It's a fabulous institution from that perspective and the way it's been structured. The gold swaps he referred to were made with Portugal's central bank in February of 1977. Portugal had a revolution that started in 74. It lost all of its African colonies, and it was bankrupt. Portugal needed to borrow money, dollars, to defend its currency at the time. And it put up gold as collateral to the U.S. Treasury in exchange for dollars. So it was a gold swap. The Portuguese central bank lent gold to the Treasury. In exchange, the Treasury lent dollars to the Bank of Portugal in order so that Portugal could defend its currency at that time. And that was the last time that gold was used in a swap. I think it's possibly the only time since World War II that the gold has been used for a swap and that has been reported by the U.S. Treasury.
Well, it's a great explanation, except that I can do it from our standpoint. It's much simpler. We had Senator Bunning, Kentucky, wrote Alan Greenspan asking him about gold swap operations and what we found in the Fed minutes. And Greenspan went to Virgil Mattingly, a senior counsel. He came back and said that the Fed minutes were, quote, garbled. That's the key. So that's our point. He didn't go back and say all about Portugal or all this or give any. He said the Fed minutes were garbled. Now, if anyone believes the Fed minutes were garbled, I got a bridge to sell you. That's it.
All right, let's go on to the second question that you have asked of Jeff, and that is Fed Chairman Alan Greenspan's testimony to Congress in July of 1998, acknowledging that central banks lease gold to suppress its price, not to earn a little money on a supposedly dead asset, a canard repeated in the Market Watch story. And, Jeff, do you want to respond to that?
Okay, well, Greenspan actually said, and first again, you need to take it into a context. Greenspan was testifying about congressional plans to regulate OTC derivatives. And I should stop here and say that I have actually been a proponent of regulations of OTC derivatives since 1984, and I'm on the record as saying that. And I was on the record in the 1990s and in 2002. The last time the Congress did. But I'm also on the record of having OTC derivatives regulated in a reasonable and efficient fashion that allows them to serve real economic purposes to the many corporations, half of the Fortune 500 manufacturing corporations that use OTC derivatives, for example. But Greenspan was talking to congressional concern that banks and brokers could actually suppress the supply of oil. And he was saying, no, that's not really true, because if you look at OTC derivatives, the vast majority of privately negotiated OTC contracts are settled for cash rather than through physical delivery of the commodity. And that's true across financial markets. And you have to understand, I should point out here, that all commodities have forward contracts written against them. I don't know of any commodity that doesn't have forwards on them, exchange-traded commodities. And in those forward contracts, the vast majority of them are never settled for cash. They are rarely settled with physical material. The vast majority of forward contracts across all commodities, as well as interest rates and currencies, are settled for cash as opposed to through delivery. Anyway, Greenspan was talking about this, and he said, unlike farm crops, private counterparties in oil contracts have virtually no ability to restrict the worldwide supply of this commodity. Even OPEC, he said, has been less than successful over the years. Nor can private counterparties restrict supplies of gold, another commodity whose derivatives are often traded over the counter, where central banks stand ready to lease gold in increasing quantities should the price rise. That's what he said. He said nothing about leasing gold in increasing quantities in order to suppress the price. And this goes to the core of my complaint about GATA, which is that GATA regularly takes somebody's quote, a legitimate, accurate quote, and distorts it to make it sound nefarious in some way. Greenspan wasn't saying anything about central banks trying to distort or suppress the price of gold. He was simply saying that if something happened in the gold market and the price started to rise in the mid-1990s when he said this, there were other central banks out there that would probably be likely and willing to lease increasing volumes of gold in order to take advantage of the higher price.
Central bank, Alan Greenspan, central banks stand ready to lease gold in increasing quantities should the price rise. When we started GATA, and then we realized what was going on, we realized this is exactly what was happening. Robert Rubin started the gold leasing program when he was working in London, Goldman Sachs CEO, and he borrowed gold from central banks when interest rates were much higher. I don't know, 8, 9, 10%. He realized he could borrow 1% if the gold was steady or low or didn't go up too much. It was an incredible way to fund his operation. He took that idea to the administration when he became Treasury Secretary, and this was the essence of his strong dollar policy. And they carried out to U.S. operations, and this is what God has discovered over a period of time. That's why we think whether it's gold swap sales or gold leases, the central banks don't have the gold they have. That's less than half the gold they say they have. And we stand by that. It's what we learned in our years of watching the market and so on. And it's pretty clear to us, and if somebody wants to look at it from a different viewpoint, fine. We're very comfortable, and that's understanding what was going on and why and what it was going to mean down the road has helped us in analyzing the market these past 10 years and being right for 10 years.
Yeah. First off, Bob Rubin never worked out of the London office. I worked at Goldman Sachs from 1981 until 1986.
Well, it was around 1988, and I know this for a fact because Brian Hinchcliffe, the CEO of Kirkland Lake Gold, worked for him.
Bill, I'm going to give you a chance to respond to Jeff. Let Jeff respond, please, and then you can come back.
I know Brian Hinchcliffe. I know Bob Rubin. I worked with both of them when they were at Goldman Sachs. Brian Hinchcliffe was long gone from J. Aron and Goldman Sachs by 1998, and we won't go into his history. But I can tell you this, when I was at J. Aron, prior to Brian Hinchcliffe coming to J. Aron and prior to Goldman Sachs buying J. Aron, we were borrowing gold from a number of central banks. We helped start that industry and jumpstart that industry, and I remember it was very interesting to go to see central banks and say, we want to borrow gold from you, and they'd say, how are you going to do that? Because it was a new concept, and this goes back to 1980, 81. So a lot of your history and your dates don't jive with reality.
Well, thanks for clearing that up for me. I stand with what we said. Ryan's a friend of mine. He was there. He did the trades. I think it was around 1988. That's the story as I know it, and I would believe that to be
gone from Goldman Sachs by 1988.
It was around that period of time, and I'm just telling you how this got started. If you want to disagree with it, fine.
No, I'm sorry, but there are facts and there's truth and there's not truth. And if you know anything about what was going on at J. Aron, when Brian Hinchcliffe was there, he was actually never involved in central bank gold lending. He was working with mining companies at that time. The central bank desk was managed by somebody else, and Rubin never worked out of London.
All right, gentlemen, let's move on to the next issue. It seems like there's disagreement there regarding facts. The third question, and this relates to Barrick's gold claim made in a U.S. District Court in New Orleans in February of 2003, to share the sovereign immunity of central banks against lawsuit insofar as Barrick was their agent in shorting gold to help control its price. Jeff, how do you respond?
Well, Barrick in February 2003 was facing a lawsuit from Blanchard and Company. Barrick filed 2 motions to dismiss and a memorandum supporting those motions to dismiss in February of 2003. And we've actually posted those on our website in the free library portion of our website. And you can read them. They're 3 legal documents. And nowhere in those 3 legal documents will you find Barrick claiming to share sovereign immunity of central banks against the lawsuit. They simply don't claim that.
Bill?
Well, we claim that they do. And way back when, we stumbled into this, we realized that Barrick was part of the price suppression scheme with the bullion banks. Their political connections, their honorary board, and so on, was loaded with all kinds of politicians, Mulroney of Canada, and so on. And you have to wonder how these guys were supposed to be the smartest in the whole business that they could hedge something like, 15, 18 million ounces all at the bottom and covered it with a $7 billion loss. Can you imagine the oil industry doing something like that? Hedging oil at $10 a barrel? They were in consort with the bullion banks, and it hurt them terribly with their share prices, which is why recently they have to get out and have, I don't know if they're out all their hedges or not. They never tell you the truth, or haven't over the years. They hide a lot of this stuff, but I know they've gotten out of a lot of it. And I think something like a $7 billion loss. I mean, how can they be that dumb? I mean, it doesn't make any sense.
Bill, but is there a claim in that district court that they wanted sovereign immunity?
No. What they're saying is they claim sovereign immunity as a reason that they didn't have to go through with a court case. And here's what's of interest. One of the top executives for Barrick was in London, was extolling hedging. I forget if it was the CEO at the time. And the next day, he left for New Orleans, and then I think might have been Peter Monk announced that Barrick Gold would not do any more hedging. I mean, it was dramatic, and that's on the record. And so it was a very exciting development for us. And as far as Blanchard and the lawsuit goes, it was settled out of court.
I mean, this goes to the core of my argument about GATA. They made a statement. You read the quote. They said that Barrick claimed sovereign immunity because they were acting as an agent for central banks. When you and I ask them about that, they talk about Barrick's hedging, Barrick's de-hedging, Barrick's losing $7 billion, but they do not say, yes, that actually is an accurate quote. And in fact, they can go to my website just as all of your listeners can go to my website. They can read the Barrick documents that were submitted in a federal court in New Orleans, and they can see Barrick never claimed that the way GATA claims that they claimed that. And, I'm a big guy about truth.
Are you denying that Barrick agreed to stop hedging because of this lawsuit?
Yes, I am.
Well, that is total crud.
Well, you see,
let's go on to something else. This is boring.
No, excuse me, but let's talk about that crud a little bit. I worked with Barrick as an advisor from its inception.
Yeah, did you advise them to hedge at the bottom? No wonder they lost $7 billion.
I advised them to hedge in a number of ways which caused them to earn billions of dollars more than they would have earned otherwise. And I'm familiar with the rationale that went behind their decision to stop hedging. And it's not because of the Blanchard lawsuit.
Are you saying that their CEO didn't unexpectedly leave London and go to New Orleans the next day? Is that what you're saying?
I don't know what incident you're talking about.
Well, I do.
What CEO was that?
I forget who it was at the time.
Let's go back to your claim. Are you admitting now that Barrick never actually claimed sovereign immunity?
Yeah, I am. I'll have to go look it up. But yes, they claimed that as a reason.
So you are claiming that they claimed it?
Yeah.
Okay, but they didn't. The documents show clearly that they did not say that.
Well, I'll tell you what. I will look it up, and I'd rather get on to more important subjects. I will send it to Jim. How's that for his listeners?
I think there's nothing more important than honesty.
Well, thank you.
Gentlemen, let's move on to the next point. The annual report of the Reserve Bank of Australia for 2003, which asserted that central banks hold gold for intervention in the currency markets. Jeff, please respond.
Here's someplace where GATA actually speaks almost the truth. The Reserve Bank of Australia did say that. Now, the honesty is you take a deep breath and you say, you know what? Central banks hold all of their monetary reserves, including all of their foreign currencies, their gold, their positions in the International Monetary Fund, and their position in special drawing rights, primarily to intervene in currency markets. That's the purpose of monetary reserves. That's the purpose of central banks. And to say, well, this is somehow or other skewing the system is similar to saying, well, we shouldn't have fractional reserve currencies. We should go back to the days of the Phoenicians when it was an eye for an eye and a tooth for tooth, ounce for an ounce, and that was it, and everybody starved and died of tetanus when they were 20.
Bill?
He said intervene in the gold and currency markets. We stand on what they said. You talk about the truth. They said intervene in gold and currencies. That's what they said. And it was indicative of what the central banks have done since God has been involved in this. But mostly it's been at the behest of our government and the Bank of England, which everybody knows about at this point.
Let's move on to point number 5, and that is a speech given in June of 2005 to a conference at the Bank for International Settlements in Basel, Switzerland, by the head of the bank's Monetary and Economic Department, William S. White, who said that a major purpose of international central bank cooperation is the provision of international credits and joint efforts to influence asset prices, and in parentheses, especially gold and foreign exchange, in circumstances where this might be thought useful. Jeff?
Okay, Bill White actually is a friend of mine, and when GATA started quoting him this, I called up Bill and I said, did you say this? What's the story? So yeah, it was a speech in 2005 to a group of academics on the role of international cooperation among central banks. And when I was talking about this, I was referring to the central bank gold pool in the early to middle 1960s. Now, in the early to middle 1960s, we were on a dollar gold standard, and the official dollar gold price was $35 an ounce. So whenever the unofficial or private market gold price centered in London and Zurich got away from that $35 per ounce, which was the official gold price, central banks had to come in and buy or sell gold or dollars or currencies in order to, either weaken the dollar to bring it back down to $35 an ounce or strengthen gold to bring it up to $35 an ounce. So back then, when we had a dollar gold system, one of the purposes of central banks was to manage currencies and gold reserves such that all of the currencies aligned with the dollar, and the dollar aligned with gold at $35 an ounce. And that's what they did until 1971 when they floated currencies. And he was talking about this period in the 1960s. He wasn't talking about anything post-1971. He was talking about history.
Bill?
Well, the gold price has been fixed and managed. It seems like forever off and on in the United States. And in the past, it was done openly. Now it's done surreptitiously. And that's what got us stands. We stand on what the guy said. He talks about intervening in the gold market. He didn't say past tense. And so that's where we stand. And we take him at his word.
Let's move on to point number 6, and this is the final one from the March document on GATA's website, and it goes like this. The memorandum recently discovered in the archive of a former Fed chairman, William McChesney Martin, detailed a scheme for the U.S. government to rig the currency in gold markets surreptitiously and to obfuscate, falsify, or withdraw government publications so the scheme would not be discovered. How do you respond to that, Jeff?
Well, okay, William McChesney Martin was the Federal Reserve Governor in the 60s, and the memo that he wrote was on the 5th of April in 1961. At that time, again, we were still on a dollar gold standard, and one of the things that central banks did was they tried to maintain the value of the dollar at $35 per ounce. So when the dollar and gold prices started to move away from that, they would have to intervene in the market. Now, in April of 1961, if you remember, the U.S. dollar was under tremendous downward pressure, and we were actually in a situation where they had to quickly try to withdraw the silver from silver circulating currencies and silver certificates because there was so much downward pressure on the dollar and consequently upward pressure on gold prices and on silver prices. And the Treasury was saying, we have a real problem here in that we're strapped to this $35 an ounce gold price, and we have to do things here, and we need the Fed, because the Fed works as our agent, to help us on it. And McChesney Martin said, we can do this, but one of the first things you know about intervention in the currency markets, and it's true of central banks, but it's also true of private institutions, is it's much more effective if people don't know what you're doing. They only see the effects. I mean, there are reasons why people don't want the market to see them coming. And McChesney Martin was saying, look, we can go in and we can intervene in the currency market and in the gold market to try to maintain the $35 an ounce gold standard for you. But you have to understand that we have certain reports that come out on a weekly, monthly, quarterly, and annual basis. Now, for interventions to work, it's best if they're not really seen at the time. And it's okay to say after the end of a quarter or at the end of the year, oh, by the way, we came in and we did this. But with the Fed having weekly and monthly reports, that gives us a very limited of time for the Treasury and the Fed to do these open market transactions. So what McChesney Martin was saying was, what we may want to do is suspend some publications, simply so we don't have to report these things, because at the end of the day, we report everything we do, down to the number of pencils we buy. And so if you want us to intervene in a surreptitious, to use GATA's word, way, so that the market doesn't necessarily know why the dollar is strengthening at this given time, then maybe what we need to do is suspend publications for a while so that people don't see us reporting this almost immediately. That's all he was saying. And again, it was 1961 when we were on a dollar gold standard.
I couldn't have said it better myself. I thank you. The intervention works best when you don't know what's going on. And that's been GATA's point since our inception. And we believe that's what's going on, and we have enough evidence to show that's the case. And that's where we come from. They don't want people to know what's going on. We're suing the Fed regarding gold swap operations. Under the Freedom of Information Act, we've asked for a bunch of stuff, and they deleted hundreds of pages. They redacted others. And supposedly there's been nothing going on with the gold reserves forever, and yet they won't give us any of this information. So we are suing them under the Freedom of Information Act in District Court in Washington to get this information. If there's nothing going on, then there's nothing they need to hide.
I want to move on to another issue, and correct me, Bill, if I'm not expressing your views completely, but you would argue, or GATA argues, that if you take a look at the London markets and you look at the amount of paper gold that's traded, and Jeff, you've documented this in your gold book, it's about 100 to 1 in terms of the physical market, and that Bill GATA's argument is that all of this gold that is being sold that is greater than the amount of physical bullion is suppressing the price of gold. So let's talk about paper gold versus physical gold. And once again, Bill, I'll begin with you.
Yeah, this is fantastic, and there's probably a lot to go in here because, just right, I've never been a big aficionado looking into the London bullion market. I was a big-time trader at one point here, and one of our guys, Adrian Douglas, on the board of directors, started talking about 4 or 5 months ago about this incredible trading volume, and it didn't seem like the physical market could support it. And he said it was like 50 to 1, and I said, Adrian, we got to be careful about talking stuff like this because that seems outrageous. If that's true, this market's going to blow up. And sure enough, at the CFTC hearing, Adrian started mentioning 50 to 1, and Jeff, to his credit and to our delight, said, no, it's 100 to 1. And he believes everybody understands this, but we don't think that's true. And the key point here is that, and it gets in the physical market and the paper market, the CFTC believes that these monstrous positions of HSBC and JP Morgan are hedged in the market in London. Yet when Jeff was speaking, and he said he misspoke, but it was a slip of the tongue, which should really be the truth, he said, well, when the price of silver was going up and up and up, they just sold more. And Gary Gensler, who was the chairman of CFTC, said, huh? And
actually, I didn't say that.
Oh, you did say that.
No, I didn't.
Yeah, you did. It's on the record. You want to look at, did you not say you misspoke? Did he not correct you?
He asked me to clarify something, and I clarified it, but what I did not say was when the price was going up and up and up, they sold more.
Okay, well,
you just said I said. So you are lying about what I said.
Well, we can go over the record, and again, we can point this out to Jim's listeners and, not waste a whole lot of time on it. That's what I stand by that. I was there. I watched you speak, and you said you misspoke. And we don't think you misspoke.
Something different, and I clarified it when Gensler asked me to clarify it.
Well, you shook him up, I can tell you that.
Well, let me ask you this, and either one of you can address this. We often see in the investment business, we see it with hedge funds, sometimes with money managers. Let's say I want to go long the gold stocks, but I want to hedge my position so I may short gold, or vice versa. I'm long bullion, I may short the stocks. What's wrong with that where the paper markets allow a hedge to come in play where an investment manager can hedge a position that he may be nervous on or maybe doesn't want to get caught on the wrong side of the fence, so he's hedging his bet?
Well, hedging is a spectacular tool for the commodities business and futures markets, and very valuable. It's just, if it's used in a normal way, it's fine. When it's done in coordinated activity to suppress the price, as Goddard claims, then it's illegal, and we think that's what's happening. As some of your listeners may know, that the New York Post has reported that the Justice Department and the CFTC are looking at JP Morgan for manipulating the market, which is not hedging. It's called a Texas hedge in a way. It's hedging a short with more shorts. And we think in the weeks and months ahead, there are going to be all kinds of scandals developing on this, and we'll stand by that.
Jeff?
Jim, to answer your question, obviously I have no problem with institutional investors, corporations, and others using derivatives to hedge. I've made a career in helping them do that, and I think it's just like using cars and planes and penicillin. I think it's something that helps modern life be a little bit better than pre-modern life was. Bill took us off message, and I don't want to do that, but he did mention these allegations of a DOJ investigation of JP Morgan, and I hope I will let you moderate the debate, but I hope you do circle back to that at some point.
Well, let's pick up on the New York Post article. What about that, the investigation supposedly into JP Morgan for manipulation of the silver market? Bill, you want to comment, and Jeff, you want to follow?
They haven't filed any charges yet, and I'm just said that they're looking at it. They came back. There's so many complaints against JP Morgan that they have a letter they sent out mentioning Morgan's name. And, it's public information. And there's rumors of the CFTC picking up stuff and looking at it further. I don't know exactly what's going on there, but I know that there's the rumblings that are liable to surface in the next week or two to next 3 or 4 months will just stun people. And I think JP Morgan's in deep trouble with their massive gold, silver, and short positions. And it's part of the reason that all of a sudden the gold market has taken off. It's the bottom of the market with the CFTC hearing when we made our big claims and statements. It was around 1085 in gold. Look what's happened since.
Jeff?
When I first saw the New York Post article, I saw the reprint of the email that the Citizens Complaint Center presumably sent to this investor, an investor having contacted them and said, will you look into manipulating the silver futures market? And I saw that, and I looked at it. First off, they don't say that they're investigating J.P. Morgan. The quote in the email is, the suggestion that J.P. Morgan Chase may be signaling other traders warrants further analysis. Sincerely, the Citizen Complaint Center, Antitrust Division, Department of Justice. And I looked at that and I said, well, this is a form response to someone sending an email to the Citizen Complaint Center. It doesn't say that they are investigating or that they will investigate. It's saying that, well, that suggestion that there may be something illegal going on here warrants further analysis, and that's the end of it. But then I looked at it more closely, and the first thing I realized is that the email that the Post reprinted is from an address that's not a legitimate email address at the Department of Justice. So then I called the Department of Justice, and I actually spent more time than I wanted to on this, but I could not find anyone in the Antitrust Division that would say, yes, we actually sent that email. So I looked at that email, and I said, okay, on the surface, let's assume it's legitimate. It's meaningless because they're simply saying, yeah, this is true. As you suggest, maybe somebody ought to look into it. But then there is the potential, which goes to some of the things that other people in the gold market and silver market have become concerned with since March. There's a potential that this actually is not a legitimate email from the Department of Justice, but a fraudulent one.
Well, I'd like to say one comment here, because, he said, she said. I don't mind admitting if I'm wrong. Would you do this, Jeff? If there are and I say if because I don't know, but if the CFTC charges Morgan or if the Justice Department charges Morgan, would you be willing to admit you're wrong?
I haven't said that these guys have done anything wrong, but I will say
that. No, but you being wrong about all this conversation we're just having about if they charge them for manipulation, which only time will tell, would you admit that they're wrong? Or you're wrong, sorry.
If the Department of Justice charges... First off, I haven't said that they haven't. What I said, you have to understand, though, words are important. What I said was that I have been unable to find anyone in the Antitrust Division of the Department of Justice who is willing to say this email actually came from us. And I have said that the email address on the email, as reprinted in the New York Post, is not a legitimate Department of Justice email address. Neither of those things say that the Department of Justice is not, in fact, considering investigating J.P. Morgan or, in fact, already investigating J.P. Morgan. So if they come along with a investigation or charges, as you say, I will not have said anything wrong. And you have to understand that because it's very important, not only in a court of law, but in the court of public opinion, that you be very careful with your word choices. Okay?
I'm going to get back to that.
There's something else I need to say here. I have become extremely concerned with the attitude of certain government officials in going after people in the financial markets in what appears to me to be an effort to find scapegoats. I have seen, not with the Department of Justice, but with other portions of the U.S. government and with other governments in other countries, overzealous prosecution. And I'm going to take the Constitution's approach that everyone's innocent until proven guilty.
Well, just to conclude on this, we're going to move on here, but the Department of Justice had, in talking to the Post and other people, has had every opportunity to say it was bogus. They never said that. They just said no comment. And that's according to Michael Gray at the New York Post. If it was bogus, they would be the first one to decry if it was bogus. They never said that.
Gentlemen, in the time remaining, I have questions I'd like to ask both of you. And just surmising, my first question, Bill, is going to be to you. And Bill, after debating these 6 points that GATA raised last year on your website, I believe what Jeff may be saying here is that many of the assertions that have been made by GATA could be extrapolations of maybe one-off events or exceptions to the rule. Would you understand in many cases why some may question some of these assertions that have been made?
Yes, I do, actually. But when you put them all together, it's guilty beyond a reasonable doubt. I mean, this is 6 questions, and there's 600 more questions, which we put together. And again, I can't stress this enough, and again, I want to try to be as helpful as I can to your listeners about what's happening to the price of gold and why. We understood that the whole supply-demand situation was far different than understood 10 years ago. We have been raving bulls the whole time. We say gold is going to 3,000 to 5,000 an ounce. We've never changed what is going on and why. And it's going to absolutely stun people. I know when we were at the Silver Summit, I think gold was a little less than 1,000. I said the same thing. Gold's going to 3,000 to 5,000. Jeff got up and said that even though the central banks were going to be buying gold, he said the price would average $914 for the next decade. Is that correct, Jeff?
No, I think it was $941.
Okay, $941. I got the 1 and 4 wrong. So $941. So at some point here, if gold goes back down and has a huge correction below 1,000, I'm dead wrong. And I'll say, Jeff was right. But if we keep going up and gold explodes by the end of the year in silver, will you be willing to say you're wrong?
Wrong about what?
The price.
About the price of gold, yes. Wrong about a conspiracy, no.
Okay.
All right.
Just on the light side, Bill, if the gold price comes down, you won't say you're wrong. You'll say the gold suppression team is being particularly effective.
Well, that's true, but that's true. But I mean, we're talking about if it goes back to about 1,000, then something where my analysis here is dead wrong. I don't see any way that can happen, and I don't mind saying that. There's no way they could get it to stay down there. It's going to go right back up. We've had corrections, for God's sakes, all the way up. We just had a big one, and now we just made all-time highs.
All right, the next question I want to address to you, Jeff. Central banks are in the business of protecting fiat currencies. Isn't it reasonable to think that an entity that's selling fiat paper would want to suppress the price of gold? And furthermore, Jeff, we know that they try to influence interest rates almost daily. So I guess why wouldn't they try to influence the price of gold in order to protect the perceived value of a fiat paper?
I think everybody in this debate suffers from what we call gold centricity. We think of gold as being important. Now, I have, over the course of my career, advised many central banks, most central banks in the world. And I've advised them about gold, I've advised them about foreign exchange markets, and I've advised them about other things. And I can assure you that central bankers think very little about gold. Alan Greenspan was a notable exception in that he liked to use the gold price as a barometer of inflation expectations. And because he saw it as a barometer, he was dead set against government intervention in the gold market, because he said that's like holding ice cube up to the barometer. It distorts the measure. But most central bankers that I know think very little about the price of gold. And when they do think about gold, they realize that gold has become a backwater in the global financial community. In our gold yearbook, we have information, we have data on it, and you can see how prior to the dissolution of the gold dollar standard and banking deregulation in the 60s and 70s, gold accounted for about 4.5 or 5% of the world's private sector wealth, and an even greater portion of central bank wealth. And if you go back to the 20s, it was probably about 25 or 30% of the world's wealth was in gold. So in the 30s, when we got into the Depression, the idea of a government intervening in the gold market was important because the gold market was a significant portion of the world's financial assets. By 1990, up until just recently, gold was down to 0.2% of world global financial assets, and it was a backwater for central banks. So central banks looking at protecting their fiat currencies, as you say, don't think that it's important to pay much attention to the price of gold. Again, as I said, Greenspan was the outlier in that he did. Now, in terms of interest rates, central banks are charged with, in the United States at least, managing and helping set short-term interest rates. I don't know any central bank that tries to influence long-term interest rates. And if you read Greenspan's recent piece, which is out in draft form on the Internet, The Crisis, you can see that he has a lot of really good information about why central banks only look at the short end of the interest rate spectrum and not the long end. But, from my experience with central bankers talking about major macroeconomic and financial issues over 30 years now, I don't see any of them being particularly worried about what the price of gold is doing. And insofar as a lot of them still own gold, they like to see higher gold prices.
Yeah, I got to answer that one. You got to be kidding me. You know, when we first started, God, we only had a little band of us, and it was difficult to recruit people because a lot of them thought like Jeff does and still does. And then it was May 6th, 1999, and Deutsche Bank said, sell gold, it's going down tomorrow. On May 7th, Gordon Brown, Chancellor of the Exchequer, announced giving away 415 tons of England's gold at rock-bottom prices, which was helping to bail out the gold cartel because they were struggling with long-term capital management short position. And they cared a great deal about it. It was a big deal, and he's been taking, I think it cost them, I don't know, $9 billion so far that they gave it away, and selling it at auction prices announced in advance. As you said earlier, Jeff, it's better not to tell people what they're doing. So this was done specifically to keep the gold price down, and it's what brought more converts to the Gada camp, some of our top guys, than anything else that's occurred in the past 11 years.
You know, it's interesting, the Bank of England issue, because, again, as I say, we have often advised central banks around the world. And one of the things that was happening in the 1990s, which really caused consternation to the central bankers, was that private bankers would issue reports about how central banks were going to sell gold, or there are rumors that the Portuguese central bank is selling gold, there are rumors that Spain or the Netherlands were going to sell gold. And the central bankers back in the 90s were much more private than they are today. And they would call up these banks and say, we don't like being used in these articles. You know, you're trying to sort of scare investors into selling gold, and you're using rumors of central bank sales as being behind it. And as the 90s progressed, you actually started getting central bankers in the Netherlands, in Portugal, and in other countries holding press conferences to complain about rumors in the gold market that they were selling when they weren't in fact selling. So when the Bank of England started moving toward gold sales, and they actually started considering this back in the late 80s, long before Gordon Brown was around. But over the course of the 90s, as they were considering it, and they were watching all this rumor mongering about central bank gold practices, they said, when we sell, which will be 1999, they said internally and privately, when we sell in 1999, after the countries that are opting into the euro have sold, we will do it in a public auction of pre-announced volumes, as the IMF and the U.S. Treasury had done in the late 1970s, so that there'll be total transparency of how much gold we're selling. Because at the time, Bank of England had 19 million ounces of gold. It wanted to sell half of it, or 10 million ounces. And it said, if we start selling gold privately, the way other central banks were doing at the time, there'll be all kinds of rumors that the Bank of England is selling 19 million ounces of gold, et cetera, et cetera. So what we want to do is we want transparency. We're going to say, this is how much gold we're going to sell each month, and this is how much gold we hope to sell in total. And that's what they did. So it was actually an effort at transparency that caused them to do that.
Gentlemen, I want to move on to a couple final questions here so we can get them all in. And Bill, I want to address this one to you. In this decade, we've seen the price of gold and silver go up nearly fivefold. The Fed can control short-term interest rates through bond purchases, or in the case of monetization. And the bond market is a much bigger market than the gold market. If they wanted to suppress gold prices, with bullion being a much smaller market, it seems to me they could have done a far better job. Is my view of this wrong?
Well, it's actually a really good point. But as we've said, and this we've stayed on long, it's what we call a managed retreat. They realized, I don't know, sometime around 2001, they just couldn't sustain the price at those levels. They were going to gradually run out of gold. So what they do is they manage the price on the way up, so when there's too much excitement, they bomb the price. They never let it get out of control, which we think now is in the process of happening for the first time, which is why we believe that, you're going to see the gold and silver prices go bonkers this year. And if that comes to pass, we're correct. So they don't have any choice anymore because, according to our work and our people, they just don't have the gold and silver to stop it. And all they can do is try to manage it. I disagree with Jeff in that gold's a huge deal. I mean, when gold What happens when the price of gold goes up? Even now, they never talked about it in CNBC. Now it's the first thing they talk about day after day, because they look at gold as an inflation barometer, crisis barometer, confidence in the U.S. government. And yes, it's a tiny, tiny market compared to all the others, but it's symbolic. And it's a big, big deal.
Jeff, this next question is for you. You believe that GATA has exaggerated some of its claims, but you've admitted the paper market is leveraged somewhat, maybe not to the same extent that GATA says. Is it possible, Jeff, this leverage in the paper market has worked to suppress the physical gold market, and someday this very same leverage could work in reverse, where the physical market could force the paper markets to cover, causing an explosion in the price of gold, as Bill just mentioned? Could your difference in views be one reason why your expectations for the price of gold are more muted than GATA's? And furthermore, could it be that GATA is right about higher future gold prices, but maybe not because gold is kept down by manipulation, but rather by the suppression of leverage in a fractional reserve gold system?
All right. Wow. Yeah, okay, that's a lot there. Let's see if I can remember everything. First off, you have to be very careful using the term leverage. GATA, in trying to discredit my CFTC commentary, grotesquely distorted the concept of leverage and misused it. But that said, and we can set that aside, there is a tremendous amount of gold that trades in the derivatives market, forwards, futures, options, gold index notes, and gold swaps and things like that, compared to the amount of gold that trades in the physical market. And without going into all of the details of what GATA got wrong with what I said, it's not 100 to 1 per se. What I had actually said was that if you look at the futures, options, and London clearing volumes, that is 100 times annual new supply of newly refined gold. Now, the amount of gold that trades in the physical market is actually several times that. And again, they got that wrong when they tried to explain it, but we can set all that aside. There is a tremendous amount of leverage or increased liquidity in the derivatives market relative to the physical market. And it does have an effect on the gold price. I wrote a seminal piece back in the early 1980s talking about the effects of forward selling by producers on the gold price. And it wasn't what people expected at the time, and it's not what people think today. But what it was that the effect of forward selling by producers contracts the contango, and that makes short selling of positions and leasing metal that much more attractive because you have a narrower contango. And that's one of the things. Now, so your second point, could this all unwind and cause the price to spike higher? Yes, but you have to understand the but, though. The but is very important. Okay? You have seen this occur in the past. You've seen it occur in small ways, and you've seen it occur in large ways. For example, when Berkshire Hathaway bought its silver, it bought in the forward market and then stood for delivery. People did not expect it to take delivery because it was buying through Fibro, and Fibro was basically a proprietary trader at that time. It didn't usually buy silver for actual investors or users and then take physical delivery. And when Fibro started taking delivery, there was congestion in the market. There were 129 million ounces of forward delivery commitments in January, February, March, April that were hard to find the physical metal immediately to cover. Now, the price of silver went from about $5 to $8, and the silver lease rate shot up to like 80 or 90% for a day or two. Then the price came down back to $5 and down to even lower levels, and the silver lease rate came down. And the nature of the derivatives market is such that you can see these kinds of spikes if people stand for delivery, but they're spikes, and then the market comes back off because there are mechanisms in the market that allow you to take your foot off the accelerator. Toyota should have had something like this, okay? So it is possible that you will see times when people say, no, I want physical metal, and people have to scrounge for it, and the price goes up. But then the price comes back down.
Bill?
Yeah, because it's interesting, because I know about this. Jimmy DiPiazza was the broker for Fibro. And what happened was, it was around a Merriweather bond scandal. I think Warren Buffett was, the chairman of Salomon Brothers. And
Piazza was not the broker, by the way, but go on.
I know him. Anyway, the point is that the government came in and said, look, you can go ahead and do this, but we're going to audit you forever, and our accounts are going to be in there unless you get out of this trade. We'll let you get out even, but if you don't get out of it, we're going to be all over you. And I know that to be a fact. I know. So they got out. It was that simple. The government forced them out. It wasn't worth it, no matter how much money they could make.
Bill, are you talking about the 1995 Fibro position or the 1997 Berkshire Hathaway purchase?
I'm going into the Salomon Brother one, not the Berkshire Hathaway one.
Yeah. Yeah, it wasn't the government that got involved. But
it was. I know this for a fact.
Of course you do.
Thank you.
Guys, I have one more question for you, Bill, and then I want to have a question addressed by both of you. Bill, recently there have been some potentially unwarranted claims, at least in my opinion, that gold did not exist at a major bullion bank, in this case, Scotia Makata. When I heard about that, it bothered me because, by nature, operating in the investment markets, you become a skeptic. And I knew a friend, Nick Barashev, who runs the Millennium Bullion Fund, and he keeps his gold there. So I called Nick, and I had him on the program, and Nick has verified that his gold is there. I talked to two other fund managers who want to remain anonymous, but they said that their gold was there. Now, if you go to Scotia Makata's website, they have about $5 billion worth of assets they claim, and their liabilities are $3 million. So I guess what irritates me in some sense is this created a bit of a hysteria. People were concerned that their bullion held in a vault wasn't safe. I, for example, keep my own bullion in a vault. I've had it audited by my staff. I keep it there in a vault as well as my clients. And there was another story about, I believe it was Andrew McGuire, who was in an automobile accident. He was hit by another car, and it was implied or insinuated that the accident was part of a larger conspiracy plot to maybe kill or silence him in order to suppress the price of gold. In my view, is both an investment advisor and a media journalist or host, this is, in many ways, a giant leap and unfounded speculation. So I guess, Bill, help me here. Do you understand my logic and sense of aggravation, and would you care to recharacterize these events now that you have facts at your disposal?
Yes and no. Our concern is about unallocated accounts at the institutions, at some of the banks and other people, that it's backed by the assets of the institution, and that if people go to get their gold or something's happened, as you were talking earlier, that they might find it's not there. And so we stand by that a lot of it's not secured. It's not the allocated accounts at the banks that we're talking about. It's the unallocated accounts. So that's number one. So we stand by that. Number two, regarding these allegations, Andrew McGuire, you haven't heard him speaking about that, and I actually resent that, Jim, because what we said was, how coincidence that the only person, we just said coincidence, that was blocked out on the TV appearance at the CFTC was me. Then I made something they weren't aware of about Andrew McGuire, and all we said was the next day he and his wife were hit by a car. And there was a helicopter chase. It's a wild story. Yeah, it could all be coincidences. But that's what happened, and that's all we reported it. As a matter of fact, Andrew McGuire has gone out of his way not to make that inference.
Well, a final question, guys. It's obvious that both of you look at the gold market through a different lens. Yet, both of you operate in the gold market. Is it possible that despite your strongly held views, we can find an area of common ground you both can agree on?
Well, I think the most important thing is what the price does. I mean, if it goes up here and God is correct, then we should be lauded. If Jeff's right and the price goes in the tank and stays there, then we should be discredited.
Well, I think that's a gross mischaracterization of our view. We've actually been bullish on gold for 10 years. We went bullish in November of 2000. And we have, as recently as today, I was on BNN saying that I thought the price would probably be around, go to new highs over the next several weeks. To our clients, we've been saying that we think it could go to $1,320 in the next 3 or 4 weeks by early June. So I think you've mischaracterized me yet once again.
I didn't mischaracterize. I said, what the future, Jeff? I said, I'm talking about the past. I'm just talking about the future. I'm willing to say I'm dead wrong. But if this thing starts moving up to 1,500, 1,600, 2,000, then you might say, maybe God was right. If it goes in the tank, I'll say, Jeff was right.
No, the price of gold can rise for 1,000 different reasons other than market manipulation falling apart.
You're the one bringing it in there.
Currencies go down the tube. Price of gold can rise because World War III breaks out, and you can still be wrong. The price of gold could go to $10,000, and you could still be wrong.
I did not advise and stand up at the Silver Summit and say gold would average $941 for the next 10 years. I didn't say that. You did.
Well, since you brought it up twice, let me explain what I said for Jim's readers. I said, if you look at the price of gold in past bull markets, for example, in 1980, the price spiked up to $850 on an intraday basis. It averaged $612 in 1980, which was less than a third or more than a quarter off from that intraday peak. And over the next 17 years, it averaged about $390. And I said the rise from $113 average price in the 1970s to $390 in the 80s up until 1997 was the real bull market. Then I said, I will not tell you how high I think gold prices could spike before this is all over. But I will tell you that for the next 10 years, our expectation is that the gold price will average about $941 per ounce over the next 10 years. But understand that that $941 compares to the peak that we could see in the near term, the same way $390 compares to the $850 peak. And you seemed to be unable to understand the difference between a multi-year average price and an intraday spike. But that's what I was talking about, and it's very important. It actually comes to the core of the gripe I have with GATA and people like you.
I rest my case. Thank you very much.
Gentlemen, I think that we're going to not find common ground here, but for our listeners, you have heard both views expressed here, and you as a listener must form your own opinion. Bill, would you give out your website and La Metropole Cafe where our listeners could get more information?
They can go to www.gata.org, or La Metropole Cafe is what I do, LEMETROPOLECIFE.com. They can sign up for a 2-week free trial and see if it's of any value to them.
And Jeff, give out your website, please.
Our website is www.cpmgroup.com.
Well, gentlemen, I want to thank you both so kindly for your time and offering your different views. Now you, the listener, can form your own opinion. Thank you so much for being generous with both of your times.
Thanks, Jeff.
Thank you.